Good morning, ladies and gentlemen. I'm your host, Seth Julian, welcoming you to today's morning briefing. We're going to talk about the earnings report season. It breaks out this week. It starts off this week with the major U.S. banks and continues for a good 6 weeks. The reason it's of interest to us is because it generally provides a fairly reliable trade, and that trade setup is as follows. In the case of Bank of America, which we're looking at here on the chart and reports out on Thursday, we see that from the beginning of the year until today, the prices declined 12.25%. That's a serious decline for an institution this big and well capitalized. So the trade setup, oh yes, and the next factor we want to look at, of course, is this. No, my mistake is this. When this is taken from the Zacks company database, shows us that the Bank of America is expecting to have a minus 6.5% earnings report factor. That means that there's a high likelihood that the report is going to be negative, despite the fact that they're reporting a pittance of 78 cents per share in earnings. That's not very good for a big bank like that. So what this means for the setup is as follows, and this setup is universal for each and every asset during the earnings report season. If the stock has declined during the quarter and the expectation is negative, the likelihood is that in the event that the release comes out as expected, negative, the stock will fall, and vice versa in the case of a positive quarterly performance. If the stock is up and the expectation is positive, and of course the report comes out positive, then the stock is likely to pop up. That's why these trades are so popular. That's why one of the reasons, the principal reason actually, that these earnings reports seasons are so frenetic. The second reason is that normally the reports are only really of interest to most traders, the Q4 reports, because they summarize and close the entire year's performance for the corporation. And however, this Q1 report is going to be important because it's going to signify the ability of corporations to absorb or pass on inflated input costs. Remember, we're beginning a period, what is likely to be a long period of extended and high inflation due to a number of factors. And the ability of corporations to either pass the costs on and therefore maintain their profit margins, or be forced to absorb them and therefore have their profit margins reduced, will be revealed during these reports. So, ladies and gentlemen, those are the two principal reasons we're following reports. We're just kicking off the season this week. And so just let me end with one small caveat. There's risk here. There's a lot of things don't often go as they are expected. Sometimes the report comes out sterling, the price is up, and the market doesn't react as expected. So just beware. There is risk in these markets, but this is generally one of the more reliable trades we have, and that is why the market and the media and the commentariat is so frenetic about it. So, ladies and gentlemen, with that, I'm your host, Seth Julian, wishing you all the ability to trade with confidence, ladies and gentlemen. Bye-bye for now.